All right. Hello, Wall Street reporter Andrew Packer coming at you here once again. Jack Marks is out looking at some of the small cap opportunities out there in the market right now, giving us the opportunity to start off the new year looking at the big picture and what's going on in the markets. So joining me today is Michael Gayed, CFA, fantastic guy, editor of a number of newsletters. You got the Lead Lag Report. You're doing some money management. What kind of projects are you kind of involved in all these days?
Yes, it's quite a few. I appreciate the invite. So there's kind of three main things that I do. One is I put out the Lead Lag Report, which is a premium research subscription service that builds off of the 5 award-winning white papers I co-authored since 2014. 2, I'm a fiduciary. I run the ATAC Rotation Mutual Fund, which closed out last year plus 72%, which we'll talk about, as well as this new ETF RORO, risk on, risk off. And then 3, I do a lot of work with financial advisors. So advisors that are looking to grow their social media presence, given that I have over 300,000 followers across Twitter, LinkedIn, StockTwit, so on and so forth. I kind of provide guidance and consulting in terms of how to increase their social media presence. Everything that I do is trying to help and differentiate in an industry where everything I think is very cookie cutter, and in an industry where arguably it's harder than ever before to really gain traction when everybody's competing against Vanguard.
Right. I mean, that's certainly the case for sort of that buy and hold, I want to be tax efficient kind of investor. But we also just have a lot of people really in the past year where the government was shutting everything down. Everybody got $600. You're no longer dining out, spending money at the movie theater. A lot of people turned to the stock market. And I think a lot of individual investors beat the pants off the professionals last year because they were kind of engaging in some of that.
Yeah, I think that's right. Although I think a lot of that also is just because of there's concentration risk, right? So professionals tend to be professional because they're diversified and they tend to not stick their neck out. Whereas I think individuals, when they trade, may have only a select small amount of stocks, highly concentrated portfolio. And if it happened to be in those stocks that, just collapsed and then had these 200, 300% runs, then sure, they're beating the pants off of professionals. The issue, to your point, is that when they got the check, it was pretty much after the low in the stock market.
Right.
If you have another round of stimulus and everyone thinks that, well, I'm going to put that stimulus back into the stock market and repeat that same performance, the market giveth and the market taketh away.
Exactly. And I can also understand the idea that professional money manager, you have limitations on, what small caps you can get to. Most of them, they're not even small caps anymore. You're looking at $1 billion valuation. So it's a bigger, more established company. You're looking at, sort of minimum share price requirements at the professional level that just a lot of investors, the big money can't really get to, but the small money can, and they can get these big outsized gains. But even people who are buying like Tesla Motors or Bitcoin, certainly not low priced assets by any means necessary, did well. People who are buying gold, fearing inflation, did pretty well last year.
Yeah, and it kind of goes to this point that when you're in an environment where narratives rule, individuals probably do better than most professionals that are focused more on modeling, right? When narratives rule, meaning the story of Tesla, the story of Bitcoin, when people get, sucked into that powerful narrative around investments, that's when concentration risk takes place, and that can pay off. It's funny. I remember maybe 15 years ago, I was at a conference, and I forget who said it, but it just stuck with me. Somebody who was presenting said, diversification is a luxury for the rich, and that the only way you ultimately get to be very wealthy is through some degree, or mostly a large degree of concentration risk. And I think it applies to the stock market as well. The problem is the other end of that is that you could also blow up, right? So, and I think that's kind of missed by a lot of individuals.
I mean, that's certainly true with a lot of smaller companies, but if somebody put all their money into, say, Apple 10 years ago, like that became not just sort of a big company, but it's also become this company where people are concerned as to how big of a percentage it is in a passive index, just because of its sheer size and because most indices are weighted towards size. So that seems like
that's a very important point, actually. And I think that's I've been kind of talking about this quite a bit, right? There is, I think, even among professionals, an underappreciation of the concentration risk they are being forced to take, because, to your point, most market averages are cap weighted, meaning that and that they're tracking are cap weighted, meaning that the largest stocks take on a bigger and bigger percentage of that portfolio. And what happens then is that if you have a narrow market that's only being driven by a few stocks, the FANGs or whatever it may be at the moment, then the market's gains are also very one-sided, which means the losses will also be one-sided when and if when those turn. So I think that's a kind of an interesting point about how to think about investing in general, because it goes back to this point that everything's so cookie cutter. Cookie cutter means everything's largely cap weighted. And it's very hard to diversify when most of your options are cap weighted in that way that have that concentration risk.
That makes sense. I want to get back to a comment you made. You talked about sort of the market being model driven versus sort of narrative driven. Obviously professional money managers, they're going to have sort of the model they follow. They have the asset allocation sort of rules that they're bound by. But it does seem like most, smaller traders, they can really just sort of follow the narrative. So what narratives are you seeing as driving this market? Do you see those changing anytime soon?
So look, I think there's to try to figure out what chapter 2 looks like, we have to go back and reread chapter 1 for a moment. As a broad rule, I'm a big believer in the idea that nobody can predict the future. If anybody were trying to model equities in 2017, I would like to see if they saw COVID. And if everybody was modeling markets March of this year, I'd like to see if they could model a vaccine. Right? Nobody can really tell what the future holds as a general rule. So, but narratives are powerful forces that can create momentum, right? And pretty sizable trends. I think the narrative that is going to be most critical here in 2021 is the one around if the Fed is going to get its wish around meaningful inflation. And by meaningful inflation, I mean a situation where inflation rates are quite a bit higher, commodities are skyrocketing, the yield curve is steepening, and if the market starts to pay attention to the fact that we have $27 trillion of national debt that nobody seems to care about. I think if you get that inflation story in there and that creates this kind of ripple effect across multiple asset classes, this can be quite a strong year for most investments, conceivably. But it's going to have a lot of volatility. We were joking earlier about, what happens this year. I said stocks will go up and down. And that sounds strange, but I actually think that's controversial because everyone seems to think stocks can only go up because what's the narrative? It's that the Fed always has our back and the market's going to keep on having this incredible smooth run higher. It can still be higher a year from now. The path of it is really what is going to determine most people's individual portfolio performance. And my belief is that path is going to be much more volatile than people think. You can still have a boom, but you will have plenty of busts in between. And if that's the case, it's more a situation of investors needing to set their own expectations so that they don't sell at the wrong time.
That makes sense because looking at 2020, if you'd fallen into a coma January 1st and you woke up today, you'd say, oh, look, the stock market went up 15%. All my stocks kind of on average, they're up 10, 15%. That's about what it's been the past few years. And you'd have missed the whole story. You would have missed the pandemic, that big crash, the Fed stepping in, cutting rates, throwing money at everything. So there is absolutely, I think, a sense that there can be some volatility. People were expecting it around the election. That didn't really happen, probably because people were kind of planning for it because they expected it. So there's I think definitely a case for some volatility, but is it going to really be as extreme this year?
I don't think you're going to see what we saw in March. Even if, let's say, this mutation on COVID is worse than the original strain, and let's say the whole world shuts down all over again, I don't think you're going to have the same kind of dynamic purely because the Fed made it very clear they will do whatever it takes to manipulate the financial system to prevent a complete destruction of equity markets. So there is, I think, some quasi-manipulated floor, and manipulated is the right word here. Right. I talk to advisors all the time. They say, none of this makes sense. I said, no, it makes perfect sense. The Fed told everyone they will buy junk. They set a precedent this year, which I think is actually very dangerous longer term. So, but that's not to say you're not going to have these kind of very scary moments, right? And I'm personally of the belief that the more you manipulate the market, the more the market is going to fight back. And will cause more of these kind of swings in this dynamic of inflation, deflation, Fed versus reality. That's why I think it's not going to be smooth sailing. I really don't think so. I think it's going to be a lot more challenging than people think because, again, I come from the perspective of somebody who's running a risk on, risk off strategy. Right. My mutual fund's up 72%, not because it was in some tech stock. It was because it went risk off mid-January last year, went into treasuries, then went risk on March 31st and did a few rotations in between, but it got the extremes right. And a lot of my work is around leading indicators to volatility. I don't know exactly when the big volatility hits, but it seems to me that the conditions are there to surprise. And if everybody believes one thing, start betting the other thing. The other way.
All right. And now when you say risk off, like what are you looking for? And does risk off mean cash? Does it mean shorting the market, maybe buying some put options? What does that look like?
So the analogy I always like to give when I talk about the ATAC rotation fund or the ATAC US rotation ETF is I don't know the mile marker. I might crash my car, but I know the conditions. It's when you hear in the media markets going up or down, they say it's a strong risk on day, it's a strong risk off day. I don't view risk on, risk off by direction. I view it based on conditions that favor volatility. You could have the markets go down heavily, but leading indicators to risk are actually saying it's time to actually buy in. That's not a risk off day then. That's actually a risk on day, right? Now, when you talk about risk off, if you have the mindset that it's not a direction, that it's a play on the weather, the conditions, then you have to say to yourself, well, how do you execute on the conditions? Shorting does not work when you're playing conditions that favor an accident. Why? Because that's knowing the mile marker, you might crash. Nobody knows when that is, right? That's the black swan, right? And the problem with shorting is that more often than not, if you're wrong, you're going to lose money one for one because stocks go up, you lose money being the inverse. However, if you were in treasuries or you're in gold or you're in lower volatility sectors like utilities, consumer staples, and healthcare, and you follow a risk-based quantitative signal, you can be wrong in your signal, meaning you slow down entering the storm, you never have the accident, but you can still make money, right? Ideally, you want to, when you think about, how do you execute on a declining market, you ideally have to say to yourself, well, how do I play that in a way that's not going to hurt me if I'm wrong, even by a day, in doing a trade, right? So, and I think that's a really important nuance, right? When you think about how to execute, it's more than just signal. It's about when the signal's wrong and what your opportunity set is to allow you to not lose too much when the signal's wrong in the false positives. So I think treasuries probably remain the risk-off play of choice. Gold will probably be among that grouping. The dollar too, probably, just everyone is so bearish on the dollar, it wouldn't surprise me at least to see the dollar rise as a risk-off play.
Right.
But it's an interesting question, right? Because the reality is there are not that many true risk-off assets. The world is either risk-on, risk-off, and the vast majority of things we can invest in are really just risk-on beta assets, right? There's very few options that really allow you to.
And everything correlates, and people don't realize that till everyone's rushing to get into cash at the same time.
Exactly right.
We saw a little bit kind of at the tail end of March with that. So
exactly right.
So absolutely. So just looking to hedge, it would just be more playing a defensive game rather than necessarily llooking for kind of those big opportunities.
Yeah, I mean, look, you can get lucky doing that, right? I mean, that's how a lot of these big hedge funds killed it in 2008, right? I mean, I don't want to say call them just lucky based on skill. There was obviously a degree of skill in 2008 when the housing market blew up, and you had Lehman. But the reality is it's very hard to make those outsized bets on a consistent basis. Even
if you're just saying, hey, I'm still going to be long stocks, but I'm going to maybe buy an S&P 500 put option, just something to hedge, that might go up 300%, 500% if the market falls quickly enough, steeply enough, help kind of offset some of your losses, and then the market bounces back. So it does seem like you don't necessarily need to be completely out of the market to profit from a downside. Or
no. And actually, I'm really glad, because that's a really good topic too. Right? Yeah. That's a really good topic too, right? Because I think, so like in my case, right, I run, again, a risk on, risk off strategy, rotates into equities or treasuries, turnovers north of 1,000% with the mutual fund and ETF that I run. Some people view that as market timing. I completely disagree. I actually think market timing doesn't work. I actually agree with the literature. The reason market timing doesn't work is because the alternative of risk off in market timing is always the asset or cash.
Right.
The problem with cash, if you're going to try and trade markets, is that cash doesn't allow you a chance to make money when you're right or wrong. Right. So that's why treasuries are a better option to play a risk-off period. That's why I take issue when people think I'm doing market timing. It's actually not at all. I'm really doing asset class tilting based on conditions that favor volatility dynamics.
Yeah, but I mean, with rates so low right now, treasuries are pretty much equivalent to cash. I mean,
Well, it
Do you
depends on the
want to
duration,
refresh?
right? I mean, the longer you go out in duration, obviously it means more risk, right? So even though
Right.
you might be risk off in treasuries, there is still risk, obviously, because to your point, the lower you are in yields, every basis point is a bigger and bigger percentage change, right, in a
Right.
portfolio. So you don't have, it's like you're squeezing blood from the stone, right, in terms of trying to play defense. Now, that's okay, right? Because if you have a severe drawdown on equities, treasuries could still lose money in that drawdown, right? Yields could rise in that risk off period, but they're probably not going to be down 30, 40%. Equities could be, right? So the relative spread in that safety trade, yes, you might lose money, but losing a lot less can be a very big win longer term.
Makes sense. Now, we're kind of coming up on the second round of $600 checks just kind of being mailed out. It's not just monetary policy too. We're seeing just a lot of kind of spending on the fiscal policy that I think is going to stoke some inflationary fears. Sometimes that's good for stocks, but if fears of inflation expectations run too high, you can have conditions like in the 70s where you get a sell-off because nobody really knows how to predict what those inflation rates will be. I don't think it's going to be that extreme this year, but how do you protect against inflation, but also against these possible market pullbacks?
Yeah, and that's the stagflation arguments, right? That you have high unemployment and high inflation, similar to the 70s. May not be exactly like that, obviously, because that's a sample size of one from a cycle perspective, but certainly is possible. Look, I think it kind of goes back to this point that there's a difference between trend in markets and path of markets, right? So equities could be higher, bond yields could be higher by end of year. They could both be higher by the end of the year, but you could have a lot of swings in between. So how do you manage that? So you have to have as much diversification into as many different areas that can play as many different paths as possible, because you don't know the exact point that path hits. Now, in my case, I run quantitatively driven rotational strategies. I'm using leading indicators to help try to identify the likelihood of a path happening favoring equities or treasuries. So I have one particular way of approaching that. Others might not want to be as active, in which case they would allocate to my fund, or they would allocate into things like gold or maybe some Bitcoin, try to diversify into other areas that kind of march to their own beat. All those things could still lose money. But the idea is that if you are in true diversifiers, which means things that really don't correlate to the S&P, you have a better chance at navigating through that path, because at least something might be working. That's not to say do a directional bet on equities. That's more just to say do something different than equities.
Okay, and what's out there that's not correlating strongly with the S&P that people can go along with right now?
Yeah, well, and it's correlation and causation, right? So I mean that's kind of as you know, right? So I think treasuries fit the bill, gold fits the bill, Bitcoin fits the bill. Even though Bitcoin has been correlated to equities in the sense that it's gone vertical as we record this.
Right.
I don't think there's any causation there, right? So that's what I'm saying. You have to kind of look at the two together. Look, diversification is the joke about diversification is that it fails when you need it the most. And to your point, which you alluded to, everything correlates to one on the downside, except historically treasuries and gold.
Right.
So those are probably your best options.
Okay. Now, let's say we do get one of these kind of like 10, 15% pullbacks in the market, kind of a pretty normal situation. What conditions are you going to look for there to be kind of that turnaround back to the risk on, and how are you going to play that?
So, and all these are documented in these different white papers that I've presented on all over the country, and which are related to the lead lag report. But basically, there are kind of three main areas that I track because they are most directly tied to my mutual fund as well as my ETF, RORO. The mutual fund looks at the behavior of utilities and treasuries. The ETF RORO uses the behavior of lumber to gold. So the finding basically is simple. Interest rate sensitive areas of the marketplace tend to move in advance of high risk conditions. Utilities are the most bond-like sector of the stock market. When they outperform the broader stock market on a very short-term basis, history suggests stock market volatility is likely to rise on average afterwards. When you have yield curve flattening, long duration treasuries outperforming intermediate, same idea, tends to be followed by higher volatility afterwards. Lumber to gold is a play on interest rates in the sense that lumber is a play on housing. We know that housing is a leading indicator of the economy. The average home has about 14,000 board feet of lumber. So it stands to reason then that as lumber goes, so too does housing. And because it's about housing, it's ultimately about mortgage rates. So everything I do as far as trying to identify risk on, risk off conditions is ultimately about the cost of capital, interest rates.
Okay.
It's just trying to do it, and follow it using different metrics. Now, as we start the year here in 2021, and I've been noting this in the lead lag report, and even on Twitter at lead lag report,
right.
the momentum in these interest rate sensitive areas suggesting risk on has very abruptly stopped, meaning that the leading indicators that have been saying risk on is here, which had been the case for large number of months, that's starting to peter out. Now, that's not to say that you have a risk off period. If they start to flip and say, watch out, it just means the weather's worsening, slow down.
Right.
And given that the sentiment is so overwhelmingly bullish, and given that you see things like put call ratios at all-time historic lows, I do think there's a tremendous amount of complacency that could unwind it in a very ugly way. And I've used this line before. It applies to both the bull sentiment and bear sentiment. Opportunity always exists when the crowd thinks it knows an unknowable future. At the depths of March, in the low, when everyone thought the world was ending, I was one of the few that was openly bullish, even though I had gotten the risk off side right, because everyone was so convinced they knew the future. Everyone is so convinced they know the future now, just the other way. Right? That's the optimistic narrative, right? I don't know. I think it's almost too perfect to surprise people now.
Yeah, I mean, I do also think you get a lot of very short-term thinking where people just project what the market has been immediately doing and sort of extrapolate that out into the future. So March, big market sell-off, people are just thinking, okay, it's going to keep going. So they just keep selling. They fuel it. It becomes a self-fulfilling prophecy. But same thing kind of on the way up too. Just sort of, hey, this market, like you're not going to lose money in the stock market. You can just kind of buy anything that's going to go up. You can throw darts. You can try to find something. Doesn't really matter if you even research it or not. Just up it goes. So how do you kind of get people, kind of focused and disciplined, just sort of on the best opportunities rather than just following a trend?
It's very hard. I joke about this all the time to advisors. So there are these two metrics when you analyze any portfolio or strategy: up capture and down capture, which is just basically a way of saying what percentage of the upside does your approach get when the market's positive versus percentage when the market's negative. Everybody always wants to focus on just the up capture, being up more.
Okay.
Right? The reality is being down less is how you generate wealth longer term. It's the down capture, which is far more important than the up capture.
Right.
And it's very hard to get people to realize that risk is what determines wealth when FOMO, fear of missing out, is very real. And to your point, when people's attention spans are so short, all they do is extrapolate the past into the future, and not just the past, the most recent last few weeks. You have a kind of a broader issue as far as attention spans, I think, in general with society now. And you can see that in the way markets are behaving.
Right.
Yeah. So it's very hard, I think, to kind of get people to see that until it's too late. The best thing you can do, and I try and do this all the time, is just educate people and remind people that, a real outperformance doesn't come from killing it in the stock market. It comes from not getting killed.
Definitely makes sense. So just kind of looking at 2021 then, what assets do you see being the most successful for, A, not getting killed, but also B, kind of making that killing?
So look, I think in general, and we've been waiting for a while for this, this kind of commodities cycle kicking in. I think commodities are interesting from a lot of perspectives. One is it does fit the diversification argument, right? From the causation correlation perspective, they've been left for dead for a long time. And it's only a matter of time until you see meaningful, substantial infrastructure spending, not just in the United States, but globally. We've been waiting for this infrastructure, activity for a while, but it's not a matter of if, right? It's going to happen.
Right.
So I think in general, commodities are probably due for a pretty sizable cycle run. That to me is interesting from a few perspectives. One, because nobody's betting there. Two, because it's great from a diversification standpoint. Three, because it has implications on inflation. Because if commodities rise, that's a form of cost push inflationary pressure. That creates yield curve steepening, creates bonds selling off. It creates an environment actually which we haven't seen in some time, which is one where bonds are not a safe haven, right? So that to me, I think is kind of the most interesting contrarian play. Now, if that doesn't happen, maybe we will see negative rates on bonds, right? I've made this case in writings before. What the Fed really needs is higher oil. What the Fed really needs is commodities push inflationary pressure to cause yields to rise to reflect increased inflation premiums, right? Because most inflation expectations are driven by the cost, by the correlation is pretty high to the price of oil. So that would be much more important for the inflation story than anything the Fed does from an interest rate perspective. If you don't get commodities to start helping the Fed out, I don't know how much more the Fed can do. And at some point, this market, which keeps on widening in terms of the wealth gap between rich and poor asset holders' income, at some point that will come to a head. You really need commodities to prevent sort of a nasty situation, I think, where that stagflation really does come in aggressively because it's not being reflected properly.
Right. And also with this economy, there's been a lot of talk of that K-shaped recovery where, if you're Jeff Bezos, your Amazon shares were up 67% last year. You made a lot of money and you were already rich. But for people who lost their job, didn't have money in the stock market to make those big returns, they're worse off. And it looks like even with new stimulus measures, some of those other things going on, they're going to continue to be worse off. So, how do you sort of reconcile that potential K-shape with kind of the more traditional look at, sort of dealing with the economy and market cycles?
Yeah, and this has come across as a controversial idea, but I've made this point a lot, and I really am sincere when I say this. The U.S. does not need stimulus. The U.S. needs discipline. Okay, because the reality is, to your point, you do another round of stimulus, that $600 check or $2,000 check or whatever number of dollar of checks it's going to be, it's not going to matter because it's going to matter only for a short period of time for those who really need it for rent. A good portion of people will probably gamble away in the stock market. I'm sorry to say it, but it's true. And then it goes right back to the very wealthy, that 1% of 1%. So widens the wealth gap even more, that K-shape. It is remarkable to me how nobody stops and says, maybe we just have to stop with stimulus that ends up going to the wrong hands, to those that don't need it. That would be the best thing that could happen. I mean, rather than trying to tax the rich, just stop enriching the rich with stimulus measures that are claiming to be for those that need it the most. So that's why I'm actually more concerned longer term about sort of there's societal implications, I think, to what's happening here with the sheer amount of debt that stimulus is creating, with this wealth gap that keeps widening, with the stock market that keeps being disconnected from the economy. And again, all that means from an asset allocation investment perspective is have exposure to as many different possible future paths as possible, because there's a case to be made for a massive boom. There's also a case to be made for a massive bust, and nobody knows until many months afterwards.
Right. Now, you mentioned a lot of kind of big asset classes, treasuries, gold, Bitcoin. What specifically, should investors be looking at now? It feels like some people might feel like they missed the boat on Bitcoin because it's already up 10% for the year, and stocks have only been open a few hours so far this year.
FOMO is real. I mean, I keep going back to that, right? I mean, it's I don't know. I tend to not try to think about what's the next hot investment theme, but more where's the risk highest. Right, the risk is always going to be highest where everyone is convinced of a certain direction. So, and that's not necessarily a call on crypto or anything by any means. It's simply the argument that, again, the future is unknowable. So humility is critical to understanding trend reversals, right? I think in terms of, aside from commodities, emerging markets are probably a very interesting area to focus on. Now, admittedly, I've been wrong on emerging markets for a long number of years here. But, with Democrats in place, people forget broad-based emerging markets were starting to break out that out of a long, 10-year cycle of doing nothing. It reversed when the trade war started in 2018. Now you've got Dems coming in, you've got Biden coming in. It seems plausible that you have a return to globalization, or at least some kind of swing back towards globalization, that probably does help emerging markets, and that probably does result in finally some kind of a cycle that's dominated outside of the U.S. by non-U.S. investments. And I don't mean emerging market tech stocks. I mean broader based emerging market averages, which arguably are more kind of tilted towards the value style of investing. I think that's a very interesting area. I don't necessarily think it's country specific. I think there's a broad wave you'll probably see to overseas investing, and that's also consistent with the commodity idea. right? So if commodities are going to run, typically emerging markets are correlated to commodity strength, so they should kind of behave in tandem to some degree if that cycle's here. So I guess to kind of more directly answer the question, go over the areas which nobody has kind of looked at for a while. Those are probably due.
Okay, that makes sense. Absolutely. Now, obviously, the Wall Street Reporter crowd, we've got a lot of just kind of small cap opportunities we're always looking at here. Some of them are in things like gold and precious metals and other commodities that could do well based on kind of the factors you're seeing, but also some things like technology and just kind of these other areas. So, are there any areas where you would just completely want to avoid right now, as opposed to buy into?
Probably tech, because I think the tech story is so, going back to narrative, is so well known. Yes, the whole world is tech. Every industry is tech. Technology is everywhere. That doesn't mean that there isn't a situation where tech is overvalued relative to other areas, right? And if that's the case, it may not be a popular idea, but the reality is markets tend to overreact both up and down. That narrative on tech, I think, is way overdone. Yes, we pulled a lot of the future forward with COVID in terms of stay at home and all that. But the way that some of these tech stocks have reacted without any meaningful earnings or hope for meaningful earnings, to me, is a huge red flag that the story has become so much more powerful than the reality on the ground. And when you're investing, you got to ultimately focus on the reality on the ground.
Right. And it's kind of crazy to see a company like Microsoft be up 40% in a year, even though they're a big beneficiary from those work from home. But
that's right.
They're also still kind of working on, kind of continuing to play that. And, just because we have the vaccine doesn't mean this pandemic is completely and fully played out yet. And I think that could be something that surprises the markets too, because everyone's sort of expecting it to be over. As soon as we got that first vaccine news, that was when we just sort of ramped right up and just started going straight up. So.
Yeah, and look, if it's not the pandemic, it'll be something else.
Yeah,
nobody can predict. It could be something better or worse, right, going forward, even outside of the vaccine. So, that's why I think just risk has to be respected. Risk has to be at the forefront of everybody's minds. Even if you get the vaccine rollout and it's successful, we're already seeing concerns around this mutation. You've got, I think in general, there's a philosophy that I try to live by, which is that it always takes longer and costs more money than you think. The media likes to make it seem, I think, largely like it's going to be a fairly simple process. I don't think so. Even no matter who's president, it's going to take time. I really do think so.
Right. I mean, there's a lot of the economy that's it's impacted by politics, but also not, and some things that are impacted more by monetary policy. And it seems like a lot of these factors, the way they interact with each other, there's kind of a lot of different scenarios up for grabs this year, and you're probably going to see a little of everything and some ups and downs along the way.
And there's a lot of butterfly effects, right? Where you have a butterfly flapping its wings, creating a hurricane, right? It's chaos theory. So, again, it's, and this is the thing with going back to the discussion on leverage. The more debt you have in the system, the less your margin of error is, right? So, this is why I think this is really tricky, I think, and underappreciated by investors. What do you do when you have debt going vertical? I've made this point before. If debt doesn't seem to matter, why is anybody paying taxes? I mean, there's a really interesting existential situation we're entering here, I think, in terms of the system. Are we going to go full-blown modern monetary theory where debt doesn't matter and we'll just deficits don't matter and debt just keeps going up, or are we going to start saying, well, that's going to actually matter, and if it's going to matter, then how do you resolve it? There are much bigger issues at play than looking at the price to book or price to earnings, or looking at the next app that some tech company is making. There's much bigger macro things at play, which I think everyone has to be very mindful of.
Right. And I mean, we're in the middle of a crisis, and that usually leads to kind of more government regulation, intervention, control over the economy, whatever you call that. That would seem to bode well for your kind of gold plays, your cryptocurrency, even at this point, just to sort of be out of the dollar, just in case you wake up and it gets some big devaluation. What else should investors be looking at for that kind of extreme scenario?
Yeah, I mean, I think it kind of goes back to there are very few other options, right? So we're limited in terms of how much we can diversify, because diversification isn't exactly how you raise assets. I hate to say that, but that's just kind of the reality in this business. So I think to me, this is more of a game of managing one's own mindset, right? To not just look at what's happened the last 6 months, to not just look at what headlines are saying, to recognize that the future is unknowable, and to try to realize that if you don't know what tomorrow brings, that means you either have to have exposure to as many tomorrows as possible, or don't play the game. Because just because you got to cross the skating rink that's on thin ice doesn't mean it wasn't dangerous, right? So the biggest advice I'd have, I think, for anybody that in this environment now is just be careful of your own emotions, and that means don't over concentrate, and that probably means focus more on downside, not upside.
All good advice, pretty much generally anytime, but I think especially now, looking at sort of the market on a valuation basis and kind of what's going on politically and what could happen and continue to unfold. So any final thoughts, anything else you feel that, today's traders and investors need to hear?
No, I mean, look, I use this line quite a bit. Your ability to stick to a strategy matters more than the strategy itself. I always use that line because, I deeply believe in that idea, because I think the problem with buy and hold, as you know, is that very few people actually hold, right? So from that perspective, know thyself is more important than know thy investments. Once you know thyself, you can then figure out your investments, right? So know what your risk tolerance is, know how you are likely to react, be truthful to yourself. Don't get sucked into the story. Don't get sucked into the narrative. The performance might be great now, but nothing is guaranteed in markets. And if that's the case, try to focus on strategies and diversification through strategies as opposed to individual stocks or asset classes, because that's probably the best way to kind of help you stick to an approach.
All right, well, that all makes sense. Appreciate you joining us today as we kick off the new year and watch the markets sort of pull back a bit right after touching all-time highs in the morning. So always an interesting time, and you have a unique outlook, I think, on the markets. And with your track record, I think you've got a lot of good ideas that you've shared with people today, so that they're properly prepared for the road ahead.
I appreciate it. Thank you.
All right, thanks for joining us. Take care. And from Wall Street Reporter, Andrew Packer signing off.